Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. In the fiscal year ended March 2023, services exports gave India a leg up even as exports of goods took a beating thanks to the global slowdown that impacted our numbers in the latter part of that fiscal. In this episode of Business Matters, let's take a look at how trade for India with the rest of the world has behaved and what the coming months hold for us. For the year ended March 2023, goods exports crossed 6.9% in growth, but this was after the figures for March alone were revised sharply upwards, meaning that for that month, export figures for goods crossed $40 billion. It was only the second time in the whole of that year that had happened. As per initial estimates, export growth was driven predominantly by petroleum products and electronics. This was about 40% growth to each segment, and this was supported by growth in rice, which is about 15%. Experts say that they believe that the government's production-linked incentive scheme has helped spur investments into electronics manufacturing in the country. Bad news on export shrinkage came from cotton, which shrunk about 28%, iron ore, which had about minus 44.6%, plastics, and engineering goods. The services sector, as mentioned earlier, served us well, pun intended, in FY23, aided significantly by the IT services segment, which had a good run through much of last fiscal. As per initial estimate, services grew about 30% to $323 billion. Contrast that with the 6.9% growth that goods exports had shown and which we dwelt upon in the earlier part of this conversation. Interestingly, within services, a category called Other Business Services showed significant growth in FY23. And here, the growth was led by a category called, or a subcategory called Professional and Management Consulting Services. What constitutes PMCS? Economics research firm QuantEco says that as per the IMF's Balance of Payment Manual, on the basis of which India compiles its BOP data, PMCS broadly include legal services, accounting, auditing, tax consulting, management consulting, public relations services, advertising, market research, and public opinion polling services. In the graph you see on your screens, sourced from QuantEco, it is evident that net PMCS exports were negligible in December 2012, but were tending towards $15 billion by December 2022. The firm says that with PMCS in the lead, the other business services category is emerging as a prominent export growth category. So far, we've looked at the year ended March 2023. Let's take a look at how FY24 has begun. April, the first month of this fiscal, saw goods exports contracting 12.7%. In contrast, services expanded about 27%, which is about the same as the growth seen in full year FY23 for the services segment. So far, the numbers that we've been talking about pertained only to exports. Let's take a look at the import figures. Overall imports declined in April, so much so that it came down to a 20-month low. This actually helps our trade deficit numbers. Now, the question arises, the important part of this conversation, why is it important to track trade deficit for a country like India? The more you export, the more you tend to earn in foreign exchange, and that helps you add to your foreign exchange reserves or forex reserves. The more you import, or rather if your imports grow faster than your exports, then you're actually shelling out more foreign exchange. A foreign exchange reserve that helps us cover about 12 to 14 months worth of imports is seen as being healthy by some economists. As on May 5th, India had forex reserves of about $596 billion. The back of the envelope calculation will tell you that with April imports being about $66.4 billion in value, we get an average of about 9 months worth of import cover from the forex reserves that we have. This is neither healthy nor is it too great. To help add to reserves for a country like India where imports significantly exceed exports, foreign investments either directly into companies or via equity markets are an important channel to help bring in foreign exchange. If our aim is to minimize the trade deficit, that is, minimize the gap between imports and exports, then a slowing of imports is actually helping us with a reprieve. But it need not always be great news. Because if exports are a signal of external demand, imports flag demand in the domestic economy. And slowing or declining imports gives a sign that local consumption demand is flagging, and that's not great news for the Indian economy. In any case, various estimates for India's FY24 GDP growth have already factored in the global gloomy environment and said that FY24 growth for India will be lesser than in FY23. The RBI's Monetary Policy Committee had an April forecast that FY24 growth would be about 6.5%. Quantico, that we referred to earlier in this conversation, says that it looks at GDP growth at being 6% for FY24, lower than the 7% it estimates FY23 to have seen. The research firm points out that with anxiety over a global slowdown, commodity prices have already declined. The CRB index, a benchmark for commodity price movements, is lower by 13.3% as on May 16th from a year earlier. Crude oil within this has slipped about 33%. These are all encouraging signs for importers of commodities, especially for the likes of India, which imports 85% of its oil needs. But the flip side is if global growth is slowing, our exports suffer, as we've already seen. The firm says that the current account deficit for India, or the CAD, to which the trade deficit is a significant contributor, is set to be about 1.4% of GDP for FY24. This is lower than the consensus estimate of about 2%. So a newcomer to the topic will ask, is this high or is this low? So there were times when CAD had touched about 4% of GDP in the years following the 2008 financial crisis. Some economists are of the belief that even if the CAD breaches the 3% level and even if it touches 4%, it's a worry only if accompanied by outflow of foreign capital. In this instance, not only is the CAD benign, but the FPI situation is also encouraging. Foreign portfolio investors have brought in 48,000 crore of rupees since March. And with India being referred to by even the IMF as the only bright spot in a global gloomy economic environment, FPI inflows are set to increase, according to an article in sister publication Business Line last week. What further FPI inflows do to overvalued stocks in the Indian economy is another conversation altogether. What are the downside risks to the macroeconomic indicators that we've seen so far? The point is, we are still only in the second month of the fiscal year, and the rest of the year is too far out for us to be able to understand and see what's going on. But the generic risks remain the same as they have over the past 3 years. The war situation, God forbid, could worsen in Ukraine, and that could impact supply chains, in turn hitting our exports, especially IT exports, which have had a good run as indicated in FY23, but of late they have slowed down. In an earlier episode of Business Matters, we've seen how results, the Q4 results of IT services companies, the biggies, have turned in far lower than expected by analysts. TCS talked about a slowdown in decision making by IT clients that in turn is bound to impact any revenue growth. Infosys predicted that the rest of the year revenue growth would be about 4 to 7%, which is significantly lower than the growth that it has seen. That's all we have for you right now. Let's see what the coming months hold for us. If you like this episode, do not forget to click on the like button and share with your friends. If you're watching us on YouTube, do not forget to subscribe to our channel. Till we meet again, have a lovely week ahead.